Hello and a warm welcome from Hellerbar in Frankfurt. My name is Thomas Kors. This is Matthias Melms. We basically run the financial institutions business in capital markets for Hellerbar in Frankfurt. And it's now time for our first capital markets new issue outlook, primary markets outlook and look back. But as we've done already a very intensive outlook and back look, so to speak, in November, we'll keep it short on the posterior part and look more to what's happening in the future. So, Matthias, without further ado, let's run through the numbers for the last year and then focus on what happens in the current year.
We have had another good year in covered bonds with 192 billion in issuance volume that we have seen last year. We have set another record year after the GFC 14 years ago. Not as much as in 22, but we were on a good path. After the summer break, the issuance volume unfortunately went down a little bit, but at the end, the year for covered bond was not bad. We have had an excellent year for senior pref, as you can see. The issuance volume of 110 billion euros was much more that we've seen in previous year, and the reason for that was that we have seen a highly refinancing need by financial institutions that had a massive outflow from deposits, as we have seen consumer spending after the Corona crisis. Senior non-pref was a similar year as the previous year with 110 billion. We have nearly set the point on the issuance volume of 22, and here it's reflected the regulatory issuance need from financial institutions. With 321 billion of issuance volume in the SSA segment, the year was not as good as the year during the pandemic, for the simple reason that there is a lower refinancing need from official institutions in 23, with a stabilizing economy and less need for pandemic support. The year was better than pre-pandemic, but at least it was the worst year in terms of issuance volume since we have seen the pandemic.
Well, I just noted that it's very difficult to actually take the colors apart from each other. But anyway, the message that we get is we had a fantastic year for covereds, okay year for SSA, and still pretty good years for the other asset classes.
Absolutely.
Right? So how's that going to continue into the new year? We already had the first full trading week of 2024. It was a pretty hectic week. It was not much, but it was a certainly stronger week than the comparable one last year, which already was a record week then. I think in terms of euro-denominated covered bond issues, we were even a tad better this week than in 2023, correct?
Completely correct. The first 5 trading days this year show a massive issuance volume, especially from covered bonds. And what we have noticed so far in the first week was that maturities longer than 5 years are back on the table. That was a maturity bucket that wasn't touched after the summer break for nearly 4 months, as investors were reluctant to go longer with, in comparison to seniors, lower spreads for covers longer than 5 years. But these maturities are back on the table. We have seen several deals in 7-year maturity bucket. We have also seen 10-year deals, and for the very first time for over 6 months. And you can see the covered bond mark is as vital as it was a long time before. We have seen a little calm down last year after the summer break.
Yeah, I do recall that at the end of last year, many people or many issuers were very reluctant to look at long-term issues because the spread requirements were too big. Now that doesn't seem to be that much of a concern, because if we compare this week to the week number 1 in 2023, spreads are massively wider, even for German Pfandbriefe. So what's the reason for that in your view, and is that going to continue?
So what we have seen last year was that the ECB has stopped buying not only covered bond, but also every other instrument under the asset purchase program. And this lack of demand from a certain natural buyer of covered bonds led to a spread widening, especially for the tightest product, core Eurozone products in the covered bond market. So we have seen a kind of convergence in the market, but to the wider end. And I think with our forecast of 160 billion that we see for 24, we are in a pretty good balance of demand and supply, so that we think that this widening could stop this year, could stop in the first quarter. And I think we have now reached a level with covered bonds trading from mid-20s to high 60s, what we've seen for midterm maturities, where we find a stable spread level, where we can satisfy the issuance demand from banks.
I find two things interesting there. Number one, that you said we lost a natural buyer. In my view, the ECB was never a natural buyer, but what the hell. And the other thing is that the 160 projection reminds me very much to the projections we had at the beginning of last year, because they were also at the beginning in that ballpark, 160, give or take a few. So I hope the result is going to be similar this year, and we're going to talk about closer to 200 at the end of the year. But what about the other asset classes?
So when we look at senior preferred, you can see that we forecast an issuance volume of 80 billion. That would translate in 30% less issuance volume than in 23. We think that most of the needs of the issuer to replace outflow of deposit is done, and with this 80 billion we still have some issuance activity that's based on lower deposits, but most of that effect is gone from our perspective. And as we have higher spreads with senior pref, we see that we expected an issuance volume of this 80 billion that is spread across the whole year. We have a similar forecast for senior non-pref. Senior non-pref is mostly driven by the need for regulatory issuance for MREL and TLAC. We think with this 80 billion, most of the issuance is meanwhile done and is reflected in our forecast. And last but not least, when we look at SSA issuance, we can clearly see with this 300 billion, we would be around 10% in lower issuance volume that we project for 24 that we have seen in 23, for the simple reason, a combination of two facts. No need for support because of the pandemic on the one hand. On the other hand, our forecast for the economic outlook does not see a recession, in a worldwide recession, that there is overall lower issuance need from official institutions.
Well, let's hope the SSA issuers see it the same way. I'd be very surprised, because there's always need to support something in my experience anyway. But the upshot is, that's great. Covered bonds, apparently, in our projection, and most of the markets seem to agree, we'll have another vintage year. At least the reduction in what we expect to be issuance volumes is percentage-wise lower than what we expect for senior pref and senior non-pref. And as I said, with SSA, well, we'll see, the jury's out there. But volatility is likely to stay hot. What do you think are going to be the key drivers in the running year?
So, we have at the end three major points. We have wars in the Middle East. We have still wars in Eastern Europe with uncertain outcome and with definitely impacts on volatility. We have central bank policies. Now we are talking and expecting that the central banks will decrease the interest over the coming year. And with unknown consequences for the economy, the huge question will be, do we get a soft landing or not? Which on both sides, if we get one or if we don't get one, will have an impact on volatility. But I think one of the hugest unknown next year will be elections. And then we are talking about elections worldwide, especially in the US, and we also have election in Central Europe, not only the European Parliament, but we have several elections for German federal states, which could lead because of the outcome, of the expected outcome, to volatility in the market?
Well, volatility is what markets are all about as far as I'm concerned. And of course, elections are about choice. Choice is a good thing. If you look at your funding plans and your investment needs, your instrument of choice is likely to be again what, Matthias?
Covered bonds.
Covered bonds. Here we go. So thank you very much for your attention to this webcast. I hope you'll watch us again. Thank you very much and all the best. Have a very safe, very successful and a healthy 2024. Bye-bye.